Hello class, and welcome to the video lecture for Accounting for Merchandise Inventory. Learning Unit 3 is about using inventory valuation methods to calculate cost of goods sold and inventory. In the first learning unit, you learned how to journalize sales transactions when a business uses the perpetual inventory system. The merchandise inventory and cost of goods sold accounts were kept up to date after each sale. So at the end of the accounting period, when it's time to prepare financial statements, we can use the dollar amounts in our general ledger accounts in our financial statements. But what if the business uses a periodic system? A periodic system is the inventory system you learned to journalize in Accounting 110. Cost of goods sold is not calculated and recorded after each sale, and the business takes inventory at the end of the accounting period and has to calculate cost of goods sold. Recall from the video for Learning Unit 2 my example with the heads of lettuce. We originally purchased 20 heads of lettuce at 10 for 25 cents each and 10 for 30 cents each. What if we used a periodic system and did not track cost of goods sold after every sale? At the end of the accounting period, we would count up how many heads of lettuce we had left in our inventory. Let's say, for example, we have 3 left. So which 3 are they? Are they the 25-cent ones or the 30-cent ones? Or a combination? That sounds tedious to track, though, doesn't it? That's why we have inventory valuation methods. So let's review the cost of goods sold calculation from Accounting 110. We take our beginning inventory, which in this example is $4,000, which you see on the left. Next, we add our purchases in the accounting period, which in this example is $20,000. That gives us a cost of goods available for sale of $24,000. Now we subtract ending inventory to find out what the cost of goods sold was. But what is the value of ending inventory? Since we can use different valuation methods, since we can use different valuation methods, it can vary, as you see in the 4 examples here. So in the previous video, I described 3 of the inventory methods. Now I'll add a 4th one called specific identification. That means we can specifically identify the cost of each item in our ending inventory. So we have specific identification, called specific invoice here, first in, first out, last in, first out, and weighted average. So let's look at the textbook example, which begins on page 561. Jones Hardware sells rakes. Jones Hardware has the following. We have goods available for sale of January 1st, beginning inventory, 10 units at $10 each for a total of $100. March 15th, we made purchases of 9 units at $12 each for $108. August 18th, we made another purchase for 20 units at $13 each for a total of $260. And November 15th, yet another purchase of 5 units at $15 each for a total of $75. At the end of the year, Jones Hardware had total rakes available for sale of 44 at a total value of $543. So Jones counts his rakes at the end of the year and finds he has 12 left. So first let's look at the specific identification method. The cost of ending inventory is assigned by identifying each rake in that ending inventory by a specific purchase price. So let's assume that Jones Hardware knew that 6 of the rakes not sold were from the March 15th purchase, and the other 6 were from the August 18th purchase. The rakes purchased on March 15th were $12 each, so that's $72. I'm looking at the column on the right side here where we have the calculation of cost of ending inventory. Then we have the rakes purchased on August 18th, which were $13 each, so that's $78. That means the 12 rakes in ending inventory are valued at $150. If the total cost of goods available for sale was $543, and we subtract the actual cost of ending inventory of $150, cost of goods sold is equal to $393. Now what if Jones Hardware uses the FIFO method of valuing inventory? Using the FIFO method, we assume that the first rakes purchased were the first ones sold. So the rakes in the ending inventory will be valued at the cost of the more recent purchases. In our Jones Hardware example, the ending inventory is 12 rakes. We assume that some of these are from the most recent purchase on November 15th, which is 5 rakes at $15 each for a total of $75. But we have 12 rakes, so we assume the other 7 are from the next most recent purchase, which was August 18th. These rakes were $13 each. 7 rakes at $13 each is $91. This makes the value of our ending inventory of 12 rakes $166. If we subtract that from cost of goods available for sale, we get a cost of goods sold of $377. Now what if Jones Hardware uses the LIFO method of valuing inventory? Using the LIFO method, we assume that the last rakes purchased were the first ones sold. Therefore, the rakes in the ending inventory will be valued at the cost of the oldest purchases. In our Jones Hardware example, ending inventory is 12 rakes. We assume some of these are from beginning inventory because beginning inventory has the oldest rakes purchased. These purchases were from the previous year. There's 10 of them, and they cost $10 each, so that's $100. The other 2 rakes we assume are from the next oldest purchase on March 15th, which were $12 each, so that's $24. That makes the value of our that makes the value of our ending inventory of 12 rakes $124. If we subtract that from cost of goods available for sale, we get cost of goods sold of $419. So, as the last example, let's look at the average method. The average method calculates an average unit cost by dividing the total cost of goods available for sale by the total units of goods available for sale. In this example, the total cost of goods available for sale was $543, and the total units available for sale was 44. Taking the 543 and dividing that number by the 44 total units for the period gives us a $12.34 weighted average per unit. Jones Hardware assumes that the 12 rakes left are average units and therefore assigns an average cost of $12.34 to each of the 12 rakes left in inventory. So we have cost of the ending inventory of $148.08 and a cost of goods sold of $394.92. So 2 important accounting principles apply to using inventory methods. The first is called the consistency principle. This means that once a business chooses one of the 4 methods of valuing inventory, it should always use that method. It can't switch back and forth from year to year unless it has a very good reason. The second is called the full disclosure principle. This means that if a business has a valid reason to change inventory valuation methods and does so, It needs to inform all interested parties of this change. To disclose information means to not keep it secret. Finally, I want to mention some very important terms. Please don't overlook these, even though this section is small in the textbook. Goods in transit refers to merchandise that's in the process of being shipped. The goods might be shipped to the customer from the business, or they might be shipped from the vendor to the business. For example, if a business uses UPS to ship all its goods, how do we count the items that are on the UPS truck at the end of the year? Are they included in the count of inventory or not? The answer to this question depends on who pays for the cost of shipping. So FOB means free on board. FREE, free on board. And we just abbreviate that FOB. So FOB destination means the shipping cost is free to the destination. Goods that are shipped FOB destination are included in the inventory of the seller, but not to the buyer. For example, if you purchase a book from Amazon and it's shipped to you, and you don't pay for shipping, Amazon has shipped the book to you FOB destination and includes the book in its inventory until you receive it at your house. Goods shipped FOB shipping point are included in the inventory of the buyer, but not the seller. If you purchase a book from Amazon and you pay the shipping cost, Amazon does not count the book in its inventory. Now, what does it mean that goods in transit should be added to inventory excuse me, if the ownership has been transferred to the buyer? In this case, the textbook is specifically referring to goods being purchased for resale from a vendor. For example, if Amazon purchases 10 textbooks from a textbook publisher to sell on its website, and the purchase is FOB shipping point, Amazon paid for the shipping and so includes the books in its inventory. The next term is merchandise on consignment. This is when one business sells goods for another business or person, but the business doesn't own the goods. For example, let's say you make jewelry. You go to a jewelry store, and the store says it will try to sell your jewelry for a 10% commission. The jewelry store has your jewelry, but it doesn't belong to the store, it belongs to you. Therefore, the jewelry store can't count your inventory in its inventory. The next term is damaged or obsolete inventory. Inventory that's damaged or obsolete is not added to the cost of inventory because it can't be sold. To wrap up this learning unit, I'd like to do a problem from the textbook, exercise 15B-5 on page 581. 15B-5 says the Nicole Company uses the periodic inventory system. Calculate the cost of ending inventory and cost of goods sold using FIFO, LIFO, and weighted average methods. Nicole sells only one product, the SM57. Now what I've done here is I've taken the information from the textbook in which they give us the beginning inventory, units and costs per unit, as well as all the purchases, and I've done subtotals on the right hand side, and then I've done a grand total. The grand total is $2,145, and that is the cost of goods available for sale. It's just exactly like how we went through the examples in the textbook. The total number of units is $150. Now, we need this information in order to calculate FIFO, LIFO, and weighted average. So when you begin a problem like this, you do need to calculate out each of those lines and find totals. So let's start with A. And A, if we use the FIFO method, the cost of the ending inventory is the cost of the items purchased last, because the items purchased first were already sold. Remember, first in, first out? So we have 60 units left in ending inventory. The last purchase was for 50 units at $17 each, which was $850. So I'm just going to put that here on the screen. FIFO. I'm having a little trouble with my little writing pad here, so I hope you'll excuse that. So 50 of the units at 17 each is 850. So we have 60 units left. So we have to take 10 from the purchase just before the last purchase. That was from August 19th. Those were $16 each. So we have 10 times $16, which is $160. So the cost of our ending inventory, we need to add those, and we get $1,010. That's their cost of ending inventory. Okay, so now we can calculate cost of goods sold, and we can abbreviate cost of goods sold as COGS, and that is the cost of goods available for sale, which we calculated as $2,145. Remember, I worked that out in advance here, the total. So we take cost of goods available for sale and we subtract the ending inventory that we determined using FIFO, which is 1,010, and we get $1,135. That is our cost of goods sold. Okay, so let's move on to B. If we use the LIFO method, the cost of ending inventory is the cost of the items purchased first, because the last items purchased were already sold. We count beginning inventory as the items purchased first because they were purchased last year. So we have 55 of those, and those were $11 each. So that's $605. Now we need 5 more from the next earliest purchase, which is from the March 18th purchase. So those, if we look on the chart above here, those were, let's see, those were $13 each. So that's $65. Add those two together, and we get $670. That's the cost of our ending inventory, our 60 units in ending inventory. So then we can calculate cost of goods sold, which is cost of goods available for sale, $2,145. Subtract the cost of ending inventory that we just calculated to arrive at $1,475. Okay, let's move on to C. If we use the weighted average method, we take the cost of goods available for sale divided by the total goods available for sale to find an average cost per unit. So the cost of goods available for sale is $2,145 divided by the total goods or the total units available for sale of 150, and I'm going to plug that into my calculator here. $14.30. Now I want to emphasize something. The reason I brought out my calculator for this particular part of the problem is I want to emphasize that when you find an average cost per unit, you need to round it to the nearest cent first. Okay, then you clear your calculator for any future calculations. This is the number that you will use in any future calculations. This is the average cost per unit, and you want to make sure that you round it off to the nearest cent first. Okay, so now to arrive at the ending inventory, we take the quantity of ending inventory, which is 60, and multiply it by the average cost per unit to arrive at the total, which is 858, cost of ending inventory. So our cost of goods sold is cost of goods available for sale minus ending inventory, which is $1,287. Okay, now to emphasize the rounding that goes on right here, let's say, for example, let's just say, for example, that this wasn't 150. Let's say, for example, it was 151. If it was 151, let's see what we get here. 2145 divided by 151. Okay, look at that number there. $14 and 205, etc., etc. Now I want to round this to the nearest penny, which is $14 and 21 cents. Okay, and then if I were to take the ending inventory of 60 and multiply it by $14.21, let's see what I get here. I'm going to excuse me, I'm going to clear my calculator. Then I'm going to take 60 and multiply it by $14.21. Okay, we get a nice number here. $852.60. Okay, so that's with rounding the cost per unit, the average cost per unit, to the nearest cent. Now, what if we didn't do that? What if we did not round to the nearest cent? What if we just went 2145 divided by 151 equals, okay, and there's that big long number there, and let's say we don't round it, and now let's multiply it by the number of ending inventory. We get $852.32. That is what happens when we don't round. These two numbers are not the same. Now the penny difference, there's a few pennies, not very much. What is that? 28 cents. Now I'm sure you're thinking, who cares about 28 cents? Well, most businesses don't. But when you get into larger numbers, we're only dealing with 60 here. When you get into larger numbers, this difference could be material, which means it matters. So when you're completing your homework, and when you're doing the quiz, and on the exam, there's going to be a problem in which you calculate LIFO, FIFO, and weighted average. The instructions will tell you round your average cost per unit to the nearest cent before proceeding with further calculations. And it's very important that you follow those instructions, because if you don't, you will get the wrong answer. Okay, so if you have any questions about that, please be sure to ask me. Okay, so that covers Learning Unit 3. And again, please go over these examples carefully and do extra problems in my lab if you need to, because there will be a problem just like this one on the first exam.